All right, everybody, welcome back for another deep dive.
Yeah, looking forward to this one.
So this time we're going to be tackling something that I think a lot of us struggle with, which is just the absolute deluge of information in the investment world.
Oh, it is overwhelming.
You know, you've got every talking head with a different opinion. You've got algorithms spitting out predictions. You've got newsletters coming at you from every direction. It's like, how do you even begin to filter out what's actually important?
Yeah, and figure out what's going to actually make you money, right?
Exactly. And so today we're going to try to cut through that noise and really focus on what we think is a pretty compelling idea.
A very intriguing one.
So we're going to be exploring a strategy that aims to get more out of the quote-unquote safer stocks in the market, the ones that aren't making those huge swings, the ones that aren't necessarily in the headlines every day.
Right, the kind of stocks that maybe your grandma owns. You know, steady Eddie, not too exciting.
Exactly.
But the traditional thinking is that, lower risk equals lower return. So what if that wasn't always the case?
What if there was a way to sort of juice those returns without taking on a crazy amount of risk?
Yeah, that's what we're looking at.
And this is where we get into something called the low-volatility anomaly.
Ooh, fancy.
Which sounds very technical, but it's actually a pretty simple concept at its core.
Yeah.
The basic idea is that over long periods of time, stocks that have less volatile prices, those steadier stocks that we were just talking about, have actually delivered surprisingly good returns, and sometimes even better than those high-flying risky stocks that everybody's always chasing.
Which doesn't make sense at first glance, right? I mean, you would think if you're taking more risk, you should get more reward. That's kind of the basic idea.
Yeah, that's the classic risk-reward trade-off.
But the low volatility anomaly kind of flips that on its head.
Exactly. And to really understand this and how we might be able to use it, we're going to be digging into a few really interesting research papers.
Love research papers.
Okay, so we've got low-risk alpha without low beta. That's kind of a mouthful.
That is a mouthful.
The conservative formula, quantitative investing, made easy.
Yeah.
Love that subtitle.
Straight to the point.
And then the volatility effect revisited.
So we're revisiting some classic stuff here.
Yeah, we're going deep.
Deep dive.
So the mission for you, the listener today, is to come away understanding how a carefully managed approach using leverage, and we'll explain what that means, could potentially unlock some hidden performance in these low-risk stocks.
Yeah, because you don't just want to go out and buy all the boring stocks and call it a day, right?
Exactly. It's not just about buying low volatility stocks. It's about understanding how we can potentially enhance their returns and kind of change the way we think about getting exposure to the market.
Right.
So let's rewind a little bit. Take it back to the basics. What exactly is this low volatility anomaly?
So basically, low volatility anomaly is this observation that in the long run, the stocks that don't move around as much, the safer ones in terms of their price, have actually done really well.
Like surprisingly well.
Yeah, surprisingly well and better than you would expect given their lower risk.
And this isn't just like some newfangled idea, right?
Oh, yeah.
This has been observed for a while.
Lots of decades.
Yeah. So going all the way back to the 1970s, researchers like Black, Jensen, and Scholes, and then Miller and Scholes separately, and then Fama and Macbeth, they were all doing some early work on the capital asset pricing model.
The infamous CAPM.
Yes, the CAPM. And they started to find these hints that this relationship between risk and return might not be as straightforward as the model predicted.
Right, because the CAPM basically says that you should get rewarded for taking on more risk.
Yeah, that's the whole idea.
But what they were finding is that it wasn't quite that clear-cut.
Like it wasn't a perfect straight line.
Exactly. They even talked about this concept of a flat security market line.
Which sounds very technical.
But basically what that means is that the relationship between risk and return wasn't as steep as the CAPM suggested.
So maybe you weren't getting as much extra reward for taking on that extra risk.
Right. It was more of a gentle slope than a steep climb.
Interesting.
Yeah. And then a bit later in the 1990s, Fama and French, who are like the rock stars of finance.
The Beatles of finance?
The Beatles, exactly. They did some really influential work, and they found that when you properly account for a company's size along with its beta...
That measure of how much a stock moves with the market.
Exactly. That beta itself didn't seem to have a very strong relationship with how the stock actually performed.
So beta, which is supposed to be like this fundamental measure of risk in the CAPM.
Yeah, the cornerstone.
It wasn't really predicting returns as well as people thought.
Not really. It was like beta was kind of getting a participation trophy rather than the MVT award.
I like that analogy. And this wasn't just a one-time thing, right?
Nope.
Later research continued to show that this low volatility effect was persistent, It was sticking around. It was even more pronounced over time and across different stock markets around the world.
Right, so not just some weird quirk in the data.
These
It
are
was a
principles.
global phenomenon.
A global anomaly. So this is where it starts to get really interesting,
Yeah.
right? Because we're seeing this pattern in the data.
Yeah.
But the question is, why is this happening?
The million-dollar question.
Why would these less risky stocks actually end up doing better?
Right, why aren't investors piling into the exciting risky stocks and leaving these boring ones in the dust?
So what are some of the main explanations that researchers have come up with?
Okay, so there are a few really interesting theories. One idea focuses on the role of institutional investors.
So these are like the big pension funds, the mutual funds, the hedge funds,
The big players.
the big players. And these institutions often face limits on how much they can borrow to amplify their bets.
Right, they can't just go out and leverage up to the hilt.
And so the argument is that because a lot of these big institutions can't easily use tons of leverage to buy those high-risk, high-beta stocks, the demand for those stocks might be lower than it otherwise would be.
Which could push down their expected returns.
Yeah, because if everyone's trying to buy something, the price goes up. And if fewer people are buying it, the price might be lower.
Exactly, supply and demand 101.
And so on the flip side, the low-beta stocks, those safer stocks might become relatively more attractive.
And that could lead to those slightly higher returns that we see.
Okay, that's one theory. What else?
Another big factor is how a lot of investors are evaluated, particularly professional fund managers.
Right, they're judged on their performance.
Exactly, and they're often measured against a benchmark like the S&P 500.
Right, how did you do versus the market?
And low-risk stocks tend to have returns that are closer to these benchmarks, so they have lower tracking error.
So they're not zigging and zagging all over the
Like
place.
kind of hugging the benchmark.
They're more predictable.
Yeah, and for a manager who's trying to beat the market by a mile, those low-risk stocks might not seem that appealing, even if their absolute returns are decent.
Even if they're making money.
Yeah, because they're not going to get those huge outsized gains that really make headlines.
They're not going to get them on the cover of a magazine.
Exactly. And then you've got this other issue called agency issues, which sounds really fancy.
It does.
But it basically boils down to the fact that some argue that the way asset management firms are structured, they might have an incentive to create and market those riskier, higher beta products.
Because they know that people are attracted to those big potential returns.
Right. And historically, when a fund does really well, even if it's really risky, it tends to attract more investor money
It gets all the attention.
and inflows.
So it's in their best interest to maybe push those riskier products, even if it's not necessarily in the best interest of the client.
Potentially, yeah. It's a bit of a conflict of interest.
Okay, so we've got these institutional factors, and then we also have to consider just basic human psychology.
Oh, yeah. Behavioral biases always come into play.
Always. And there are a few that might be relevant here. For example, investors might be drawn to those volatile stocks that are constantly in the news.
Because they're exciting, they're getting attention.
Right, it's like that attention-grabbing bias.
Exactly. And they might also fall into the trap of being overly optimistic about those high-growth, high-risk companies.
Is they think this time it's different.
This time it's different, yeah. And that's what we call representativeness bias and overconfidence.
Right, they're thinking, oh, this is going to be the next Amazon or the next Tesla.
The next big thing.
And they're not necessarily thinking about the potential downside.
The risk, the fact that most high-growth companies actually don't become the next Amazon.
Exactly.
So yeah, it's a fascinating mix of how institutions work, how people think, and just the overall structure of the market that might all be contributing to this low volatility anomaly.
Okay, so we've laid the groundwork. We've kind of set the stage now. Let's dive into that first paper, Low Risk Alpha Without Low Beta. What are they proposing?
Okay, so the main idea in this paper is to actually try and exploit this anomaly, and they propose a strategy that combines low-risk investing with leverage.
And just to be clear for our listeners, leverage means using borrowed money to amplify your returns.
Right, it's like putting a multiplier on your investments.
Exactly. So instead of just buying a bunch of low-risk stocks and sitting on them, they're saying, okay, let's use some leverage to boost those returns.
And the key here is that they're not just randomly leveraging any portfolio of stocks. They're specifically targeting those low-risk stocks.
The ones that have historically shown this anomaly.
Right, because the idea is that the leverage itself isn't the magic sauce. It's the combination of leverage and that low-risk tilt that seems to create the outperformance.
So it's about strategically applying leverage to the right kind of assets.
Exactly. It's not just about taking on more risk. It's about taking on more of the right kind of risk.
Now, they also emphasize the importance of risk management in this strategy.
Oh, absolutely. You can't just go out and lever up like crazy without thinking about the potential downsides.
Right. Leverage can amplify both your gains and your losses.
Exactly. So they propose using a risk model to control what's called tracking error.
Which basically means how much your portfolio deviates from the benchmark.
Right. You don't want to be swinging wildly from one extreme to the other.
So they're trying to keep the portfolio relatively stable and predictable while still benefiting from that leverage.
Yeah. They're trying to find that sweet spot between boosting returns and managing risk.
So what kind of results do they actually see with this approach?
Okay, so they looked at a huge data set of developed stock markets going all the way back to 1986.
Oh, nice long history.
Yeah, really robust data. And what they found was that their leveraged, risk-controlled, low-risk strategy significantly outperformed both the market and a simple, unleveraged, low-risk portfolio.
And how did they measure that outperformance?
They looked at a bunch of different metrics, but one of the key ones was the information ratio, which tells you how much extra return you're getting for the extra risk you're taking relative to the benchmark.
It's a way to measure your efficiency.
Exactly. And their leverage strategy more than doubled the information ratio compared to a simple unleveraged low-risk approach.
Wow, that's pretty impressive. So they were getting a lot more bang for their buck, so to speak.
Exactly. And it's important to note that this outperformance wasn't just because they were using leverage. It was because they were using leverage in combination with that low-risk tilt.
Right, it was that specific combination that seemed to be the key.
Precisely. And they also found that this approach was more efficient than just buying more of those low-risk stocks with cash or using things like index futures to try to get similar market exposure.
So it was a more sophisticated and targeted way to benefit from this anomaly.
Exactly.
Now let's talk about the specifics of their strategy. How did they actually construct those leveraged portfolios?
Okay, so they started with a target level of total exposure, for example, in their developed markets analysis. They were aiming for 140% gross exposure.
So they were using leverage to boost their exposure by 40%.
Exactly. And to achieve this, they use something called synthetic positions, which are basically ways to gain exposure to more stocks than you physically own outright.
So it's kind of like you're making a bet on those stocks without actually buying them directly.
Right, and they often use things like futures or swaps to do this.
And importantly, they didn't just lever up blindly. They used a risk model to actively manage their tracking error, which means how much their portfolio was expected to deviate from the market benchmark.
Yeah, they were trying to keep their portfolio's movements relatively in line with the market's movements, even though they were using leverage.
And this proactive risk management was a key part of their approach.
Absolutely. It's what sets it apart from just borrowing a bunch of money and buying a bunch of low-risk stocks.
Now, they also didn't just pick any low-risk stocks. They used a multi-factor approach to try to identify the most promising ones.
Right, they weren't just throwing darts at a board.
Exactly.
Yeah.
So they looked at a combination of factors, including low risk, value, quality, and momentum, with low risk having the highest weighting.
Yeah, low risk was the main ingredient, but they added those other spices to enhance the flavor.
I like that, and they specifically mentioned that this blend of factors was inspired by something called the conservative formula, which we'll talk about more later.
Right, that's a really cool connection.
And for the low risk factor itself, they used a combination of historical volatility and beta. So they were looking at both how much a stock's price had moved in the past and how sensitive it was to the overall market.
Yeah, they were trying to get a comprehensive picture of a stock's risk profile.
And they used some sophisticated statistical techniques to help manage the overall risk of the portfolio.
Like a variance-covariance matrix.
Which sounds very complicated.
It is, but basically it helps them understand how the prices of different stocks tend to move together.
So they can build a portfolio that's not overly concentrated in any one area.
Right, diversification is key.
Always. So in their research, they compared 3 different strategies. The unleveraged portfolio, which had 100% exposure, the leveraged portfolio with 140% exposure, and then the leveraged portfolio with active tracking error control, which they labeled 140 TE.
Yeah, they really wanted to see how those different approaches stacked up.
And they looked at a whole bunch of different performance metrics to get a complete picture.
Like return risk, Sharpe ratio, information ratio, maximum drawdown, you name it.
The whole shebang. So what were some of the key takeaways from all of that data?
Well, one of the most striking findings was that the leverage strategy with cracking error control significantly increased the information ratio, as we talked about earlier.
It more than doubled it.
Yeah, it went from 0.43 to 0.92, which is huge.
Huge. And it also showed a really nice increase in excess return.
Right. That's the return above and beyond what you'd get from just holding a risk-free asset.
Like a treasury bill or something.
Exactly. And they achieved this while keeping the overall volatility of the strategy pretty much in line with the market.
So they weren't taking on a ton of extra risk to get those extra returns.
Right. It was a pretty efficient way to boost performance.
Now, I did notice in their results that the Sharpe ratio, which is another common measure of risk-adjusted return, actually decreased slightly.
Yeah, that's an important nuance to point out.
So how do we reconcile that with the big jump in the information ratio?
So the information ratio is specifically looking at how much extra return you're getting relative to a benchmark, in this case, the market.
Right. It's a relative measure.
Exactly. Whereas the Sharpe ratio looks at the total return per unit of total risk, regardless of any benchmark.
It's an absolute measure.
Right. And so what this suggests is that while the leverage strategy was really good at delivering extra return relative to the market, it might not have been quite as efficient in terms of its overall use of risk.
Okay, that makes sense.
But even with that slight decrease in Sharpe ratio, the leverage strategy still had some really impressive results.
Yeah, for example, the maximum relative drawdown.
That's the biggest drop you would have experienced compared to the market.
Yeah, the worst case scenario, basically.
That dropped dramatically from 22% down to just 12%.
So you're potentially getting much better downside protection.
Yeah, you're riding out those market storms a lot more smoothly.
And that's something that a lot of investors are really concerned about.
Especially if they're thinking about using leverage.
Exactly, because leverage can magnify those losses.
So having that built-in risk management is crucial.
And the authors of the paper make a really interesting point. They say that this strategy is essentially transforming what's typically a defensive low-risk approach into something that has market-like risk, but with potentially much higher expected returns.
Right, they're taking that boring, low-volatility approach and giving it a turbocharge.
A turbocharge, yeah, I like that. And they showed some really compelling charts in the paper to illustrate this.
Oh yeah, Exhibit 3 showed how these different strategies performed cumulatively over time.
It was really interesting to see how the leverage strategies, especially the one with risk control, really shined during those long bull markets.
Right, they were able to capture a lot more of that upside.
And the risk control strategy also showed a much more stable performance during those periods of market stress.
Yeah, like the dot-com bubble burst or the COVID crash.
So you're getting more of the good times and less of the bad times.
Potentially, yeah. It's a pretty attractive combination.
And then they had another chart, Exhibit 4, which showed how the information ratio steadily increased as they added leverage and risk control to the strategy.
It was a nice visual representation of how those two elements were working together to improve risk-adjusted performance.
And Exhibit 5 really highlighted how important that active tracking error management was.
Right. The tracking error only significantly decreased when they both used leverage and specifically penalized the portfolio for deviating too much from the market.
So they were really intentional about keeping that portfolio on track.
Exactly. And then Exhibit 6 showed that this outperformance wasn't just limited to specific market environments.
Right. They looked at how the strategy performed across different market regimes, like up markets, down markets, different sizes of companies, different valuations, and the leveraged risk control strategy consistently came out on top.
Which suggests that it has a certain degree of robustness across different economic conditions.
So it's not just a fair weather strategy.
Nope. It can handle a little bit of turbulence.
Okay, now let's get a little bit more technical. They also looked at where the portfolio's investment was concentrated based on their own forecasts of which stocks were expected to do well.
And this was in Exhibit 7.
Yeah, and what they found was that the leveraged portfolios still maintained a strong overweighting towards the stocks that their model predicted would have the highest returns.
So the leverage wasn't diluting their focus on those more attractive securities?
They were still picking the right stocks.
Yeah, the leverage was just amplifying those picks.
And they showed in Exhibit 8 how that predicted tracking error was effectively kept under control over time.
Yeah, that risk management was working as intended.
Now, a key question is whether this strategy was actually generating alpha.
Which means returns that you wouldn't expect to get just from being exposed to the market.
Right. Is it truly outperforming, or is it just benefiting from being in the right place at the right time?
Exactly. And to test this, they use something called spanning alpha regressions.
Which sounds very intimidating.
It is a bit technical, but basically they were trying to see if the returns of their leveraged strategy could be explained by just owning a mix of well-known investment factors, like those in the Fama French models.
So things like the size factor, the value factor, the momentum factor.
Right, because those factors are known to drive returns.
So if the leverage strategy was just loading up on those factors, then maybe it wasn't truly doing anything special.
Exactly. But what they found was that even after accounting for those common factors, their leverage strategy still showed positive and statistically significant alpha, especially when they used realistic long-only factor portfolios.
So it wasn't just mimicking those well-known factors, it was doing something unique.
Yeah, it had its own special sauce.
And they also found that the market loading, or beta, of the leverage strategies became statistically insignificant.
Which means they were effectively achieving that target market beta of 1.
They were behaving like the market in terms of overall risk, but potentially delivering much higher returns.
Pretty cool, huh?
Very cool. Now, of course, they also address the practical considerations of using leverage, like financing costs.
You're right, because borrowing money isn't free.
So in Exhibit 10, they looked at how sensitive their results were to the cost of borrowing.
And they found that the spread between the return on the leveraged portfolio and the cost of financing would have to be extremely high, like well over 6% per year, to completely erase the benefits of the strategy.
So even with realistic financing costs, this approach still seemed to be viable.
Yeah, it wasn't overly sensitive to those costs.
And they also looked at things like trading costs, dividend taxes, and different levels of leverage in Exhibit 11.
And again, the strategy held up pretty well across those different scenarios.
It seemed to be robust.
Yeah, it wasn't falling apart when they introduced those real-world wrinkles.
Okay, so that's the developed markets, but they didn't stop there. They also looked at other regions.
Right. They wanted to see if these findings were generalizable.
So they looked at emerging markets, North America, Europe, Asia Pacific, and the results were broadly consistent.
Yeah, that information ratio kept going up when they added leverage and tracking error control.
So it wasn't just a developed market phenomenon.
No, it seemed to be a global one.
And they even tested a simpler version of their strategy in the appendix of the paper, focusing solely on low volatility stocks.
And those benefits of leverage and risk control still held up even with that more basic approach.
So it wasn't just about the specific multi-factor model they were using, it was about the underlying principles of leveraging low-risk stocks.
Exactly.
Okay, so earlier we mentioned that the multi-factor approach in this paper was inspired by something called the conservative formula.
Right. That's a really cool connection.
So let's talk about that for a minute.
Yeah.
What exactly is the conservative formula and how does it tie into all of this?
So the conservative formula is a really simple and effective investment strategy that's described in detail in a paper by Van Vliet and Blitz.
Same authors as the volatility effect revisited.
Exactly. And it's all about selecting stocks based on 3 main criteria: low volatility, high net payout yield, and strong price momentum.
So low volatility, we already knew that one.
That's our theme for the day. Net payout yield. What's that? So net payout yield is a measure of how much a company is returning to its shareholders through a combination of dividends and share buybacks.
So it's a way to capture value.
Yeah, because companies that are paying out a lot of cash to their shareholders are often undervalued by the market.
They're giving money back instead of hoarding it.
Exactly. And then the third criteria is momentum, which is basically the idea that stocks that have been going up in price recently are more likely to continue going up.
The trend is your friend.
Exactly.
So the conservative formula is combining those 3 factors to try to identify stocks that are both safe and likely to outperform.
Yeah, it's a nice blend of defense and offense.
And it's really appealing because it doesn't require any complex data or analysis.
Right. You don't need to be a financial whiz to understand it.
You just need to look at stock prices, dividends, and buybacks.
Exactly. And the crazy thing is that this simple formula has actually shown remarkably strong historical performance.
Like going all the way back to 1929.
Yeah, they backtested it over a really long period, and it consistently beat the market, and it also consistently outperformed a portfolio of those high-risk, low-yield, negative momentum stocks that they called the speculative portfolio.
So it's not just beating the market, it's also beating the stocks that you would think would be the most exciting and attractive to investors.
Right, it's kind of like the tortoise and the hare story.
The slow and steady conservative approach wins the race.
Exactly, and the authors of Low Risk Alpha Without Low Beta were clearly inspired by this conservative formula when they were designing their own strategy.
Yeah, they took that idea of combining well-established return-enhancing factors, including low risk, and they used it as the foundation for their stock selection.
So it's like they started with a solid base of conservative, high-quality companies, and then they used leverage to amplify those returns.
It's a really clever approach.
Yeah, I like it a lot.
Okay, now the third paper, The Volatility Effect Revisited, delves into some of the more practical considerations of low-risk investing. So what are some of the key takeaways from that paper?
Okay, so one thing they point out is that while a lot of academic research focuses on those long short strategies where you're both buying and selling stocks, most investors in the real world prefer long only approaches.
Which means they're just buying stocks they think will go up.
Right, they're not shorting or betting against anything.
And the paper emphasizes that low-risk investing doesn't have to mean high turnover.
You don't have to be constantly trading in and out of positions.
You can build a low-risk portfolio that you hold for the long term.
Exactly. And they also make a distinction between low-risk strategies and minimum risk strategies.
Which sounds like they might be the same.
But they're not quite.
So what's the difference?
So a low-risk strategy is generally aiming to achieve a certain level of risk that's lower than the market, but not necessarily the absolute lowest possible risk.
Whereas a minimum risk strategy is laser-focused on minimizing risk, even if it means sacrificing some potential return.
Exactly. It's all about finding that optimal balance between risk and return.
And they also talk about the complexities of currency hedging when you're investing internationally.
Yeah, because if you're buying stocks in different countries, you're also exposed to fluctuations in those currencies.
And that can add another layer of risk to your portfolio.
Right, so they suggest that it might be better to build a low-risk portfolio that's not specifically tied to any one currency, and then hedge the currency risks separately if you're concerned about it.
So don't try to be too clever with the currency stuff.
Keep it simple.
And they also cautioned against blindly following simple low-risk indexes.
Yeah, just buying a low-volatility ETF might not be the best approach.
And why is that?
So the main reason is that those indexes are often rebalanced in a way that can lead to higher trading costs.
Because you have to buy and sell stocks more frequently to keep up with the index.
Exactly. And it can also lead to overcrowding, where a lot of investors are all trying to buy or sell the same stocks at the same time.
Which can push prices around and make it harder to get a good deal.
Right. So they emphasize that low-risk investing can be much more effective when it's combined with other investment ideas like the multi-factor approach or the conservative formula.
It's about being more selective and thoughtful.
Exactly.
Okay, so now the big question that I'm sure a lot of our listeners are wondering about is this whole low volatility anomaly going to disappear?
Yeah, is it just a matter of time before all the smart money figures it out and arbitrages it away?
Exactly.
So the volatility effect revisited actually presents some evidence that suggests that might not be happening, at least not completely.
Okay, so what's the evidence?
So they point out that historically, mutual funds, on average, have actually had a negative exposure to low-risk stocks.
Which means they've been underweighting those stocks.
Yeah, they've been favoring the riskier ones.
Which is kind of counterintuitive.
It is, but it suggests that maybe those institutional factors we talked about earlier are still at play.
Right, those leverage constraints and those performance incentives.
Exactly. And while there are now a lot of low volatility ETFs out there, their analysis shows that the overall ETF market is pretty much neutral in its exposure to low-risk stocks.
So it's not like everyone's piling into low volatility ETFs.
Not yet, at least.
And they also mentioned that some regulatory frameworks might actually be discouraging certain investors from going all in on low-risk strategies. So there might be some structural reasons why this anomaly is persisting.
Yeah, it's not just going to vanish overnight.
That's good news for us.
Good news for low volatility lovers.
So to wrap things up, it seems like this strategy of using carefully managed leverage on a portfolio of well-selected low-risk stocks offers a really compelling way to potentially enhance returns without necessarily taking on a ton of extra risk.
Yeah, it's about challenging that conventional wisdom that low risk equals low return.
Exactly. And it's about understanding that leverage isn't inherently good or bad. It's all about how you use it.
Right. It's a tool. And like any tool, it can be used effectively or ineffectively.
So for our listeners out there, think about how this information might change your own understanding of risk and return.
Yeah.
How might you incorporate some of these ideas into your own investment approach?
We encourage you to dive deeper into the concepts of factor investing, low volatility strategies, and even check out those research papers we talked about.
The links are in the show notes.
Always. And remember, while the historical evidence for these strategies looks really promising, past performance is never a guarantee of future results.
Right. The market can always throw us a curveball.
But by understanding the underlying reasons why these strategies might work, you're putting yourself in a much better position to make informed decisions.
You're becoming a more sophisticated investor.
Exactly. And that's what it's all about.
Well said. Thanks for joining us for another deep dive.
Always a pleasure.
We'll see you next time.
See ya.
Bye.